We now come to Introduction to Industry and Company Analysis. I'll first make a larger point before coming to the specific bullet points here. The larger point is that when you are evaluating a given stock, it is important to understand how the industry is doing, because you might identify a great company in an industry that is not going to do well. Then obviously chances are that even a good company in a dying industry is not likely to do that well. So understanding how a particular industry is likely to perform is extremely important. This slide deals with defining an industry, and what we are simplistically saying is that we need a way to identify similar companies. Companies can be grouped based on products or services. So when we say technology companies, this is what we are doing. We are grouping companies together based on the fact that they either sell technology related products or technology related services. Companies can also be grouped based on their relative sensitivity to business cycle. Companies can also be grouped based on their relative sensitivity to the business cycle. So you will hear about a category called cyclicals. So cyclical companies are those whose profits are strongly correlated with the strength of the overall economy, such as auto companies and tech companies. The idea here is that when the economy does well, then these companies do well. When the economy goes down, then these companies don't do so well. Non-cyclic company is one whose performance is mostly independent of the business cycle. So you might have healthcare, utilities, etc., where the revenue or the demand for their services are not very correlated with the business cycle. Example 1 in the curriculum talks about non-cyclic companies and the fact that sometimes they are referred to as growth or defensive. But these labels can be misleading. One larger point is that cyclic versus non-cyclic is not binary. You can have a company that is called cyclic, but it can also have growth characteristics. So for example, it can go up and down with the economy, but overall the profits and the revenue might be going up. So is it cyclic or growth? So it has characteristics of both. Growth defensive labels may be misleading in the sense that you might have a defensive company, such as, let's say, a company that sells toothpaste, or you might have retail outlets, so grocery store chains. But when the economy is not doing well, then even though they are defensive, but there might be extra pressures and they might not do so well. And growth companies, their growth might slow down when the economy is slowing down. Also, different regions might be at different stages of the business cycle. So you might, for example, have a particular company that's categorized as a cyclic company. But the fact is that in Europe, you might currently have a slowdown, whereas in Asia, you might have an economy that is booming. So if you take a cyclic industry like the auto industry, the fact that it is cyclic is not going to help you too much over here, because one part of the world is booming, the other part of the world is slowing down. So these are items to keep in mind before you simply start making decisions based on labels. Companies can also be grouped based on statistical similarities, but this is generally discouraged. Just understand what this is though. Companies with high correlations are grouped together. So if you figure out somehow that fashion-based companies and fertilizer-based companies, you run some regressions and you see that over the last 10 years, their returns tend to be correlated. Now that might purely be because of chance. Classification systems. A well-designed classification system is a useful starting point for industry analysis. Analysts can compare industry trends and relative valuation among companies. Recognize that broadly speaking, we have government classification systems and commercial classification systems. So government classifications are classifications done by either sovereign governments or supranational governments such as the United Nations and so on. When we look at government classification systems, continuity of data is critical to the measurement of and evaluation of economic performance over time. Generally, these government classification systems are looking at the performance of different economies of different parts of the world. So, because continuity is so important, these systems are reviewed and adjusted relatively infrequently. Generally, they do not disclose information about a specific company, so they will not tell you that in this classification which company falls exactly in which category. They do not distinguish between large and small companies. They do not distinguish between for-profit and not-for-profit companies, or between private and public companies. Commercial classification systems are somewhat different. There are several different entities that publish commercial classification systems, and very often analysts look at the commercial classification systems. One of the most popular one is GICS. This uses a 4-tier system. So at the highest level we have a sector. Within each sector you might have one or more industry groups. Within each industry group you might have one or more industries, and then within each industry you might have one or more sub-industries. Russell Global Sectors is another system. This uses a 3-tier structure. Commercial classification systems are reviewed and adjusted frequently. Generally disclose information about a specific company, so they will say that so and so company. Generally, they will disclose information about a specific company, so they will say which company falls within which industry. They also distinguish between large and small businesses, only cover for-profit publicly traded companies. So this is quite testable, the difference between government systems and commercial systems. Next, you need to understand how to construct a peer group. A peer group is a group of companies engaged in similar business activities whose economics and valuation are influenced by closely related factors. This graphic over here is one possible strategy for constructing a peer group, and I will encourage you to read this. But what we are trying to do is identify similar companies. In financial analysis, it is important to compare the performance of a company with other comparable companies. So the other comparable companies is essentially the peer group. Note that a company could belong to more than one peer group. For example, HP could be in the PC industry and in the information technology services industry. Describing and analyzing an industry. Analyze industry performance in relation to other industries and over time. So what this is saying is you do both a cross-sectional analysis where you are trying to evaluate how a particular industry will do relative to another industry. You also do a time series analysis in the sense that you say how is the industry doing today relative to how it has performed in the past. Identify industries that offer the highest potential risk-adjusted returns. You look at economic fundamentals, and hence economic profits can vary substantially across industries. The curriculum shows an exhibit where it says that at a given point in time you might have certain industries that have a much higher return on invested capital than others. Also, some industries have much more pricing power than others. And where would you like to invest? Obviously, all else equal, you want to invest in companies that have higher return on investment. You would invest in companies where we have a higher ROIC, or industries where we have high pricing power. The investment time horizon can be long or short, and this needs to be considered when you analyze an industry. Strategic groups are groups of companies sharing distinct business models or catering to a specific market segment. Industries can be classified according to life cycle. So you might say these industries are early in their life cycle, so and so industries are in a mature phase. And this also relates to position on the experience curve. So further in the industry life cycle means that they are further on their experience curve, which means that their costs of production are probably lower as they become more experienced. Industry analysis framework, Porter's 5 forces. The CFA Institute seems to love the Porter's 5 forces model, so I would say that you learn this well. I'll go over the 5 forces and then some important aspects related to some of the forces. Bargaining power of suppliers. Now, just understand the context here. Let's say you are analyzing a particular industry such as the airline industry. Now, in analyzing the industry, not only do you look at the players within the industry, you also need to look at the suppliers, the customers, and the power that these entities such as suppliers and customers have. If for a given industry the supplier power is strong, is that good or bad? It is actually a bad thing. Why? Because if the supplier power is strong, then the supplier will put pressure on the industry. The supplier will sell at relatively high prices. So understand that. Next is product or service substitution threat. So if the threat of substitutes is high, if this force is strong, that also obviously puts pressure on the industry. If you have credible substitutes, then it is very hard for the industry to raise prices. Customer bargaining forces, here what we are saying is if customers are strong and they can put a lot of pressure on the industry, then they will not let the industry raise prices. And finally, threat of new entrants. If the threat of new entrants is high, then that is also not good for the industry, because if profits are high and new entrants can just come in, then the incumbents will obviously lose profitability. From a testability perspective, you need to understand how to evaluate whether the threat of new entrants is high or not. So for that, what you do is look at the barriers to entry. Very simplistically, if the barriers to entry are high, then that will discourage new entrants, and that would imply that the industry has high pricing power. That's the simple high-level view. But there are some other points. You should not confuse barriers to entry with barriers to success. So it might be easy to enter a given industry, but the real question is whether it is easy to be successful in that industry. Also, high barriers do not automatically lead to high pricing power. This might happen if price is a large percentage of the customer's purchase decision. So even though barriers to entry are high, let's take the airline manufacturing business. So you have two major players. You have Boeing and you have Airbus, right? Obviously barriers to entry are high because it's not easy for another company to just start making airlines. But these two companies do not have too much ability to raise prices, because for airlines, which are very price sensitive, for them a major part of their expense is the airlines that they buy. Another issue is that the industry has high barriers to exit. So it is not easy for Boeing to exit the airline manufacturing business. So these are two reasons why, even though barriers to entry are high, the pricing power might not necessarily be high. Next, we look at the internal competitive forces within an industry. So look at industry concentration. In concentrated industries, each player generally has high pricing power. So some people get confused about this, so I just want to emphasize the point. Concentrated industry means few players. All right, so in theory, if you have few players, then the pricing power will be high. For each player, given that there are very few players, the fortune is tied with the industry, and there is more to gain by keeping prices higher, even though cutting prices may increase market share. So this is an important point. If there are just 3 players in an industry, they have a long-term stake in that industry, and they would not want to spoil each other's pricing power. So chances are that they will tend to keep high prices. In segmented industries, segmented is the opposite of concentrated. So lots of small players. Here each player has low pricing power, there is more to gain by undercutting competition in an effort to gain market share. Now, you might think that high concentration automatically means high pricing power, but this is not always the case. So if you have a concentrated industry, obviously there are scenarios where there is high pricing power, such as in the soft drink industry. This is a concentrated industry, and Coke and Pepsi have high pricing power. But it is also possible that pricing power is weak. Generally, in capital-intensive businesses which sell commodity-like products, we will have weak pricing power. Now, it is hard to call aircrafts a commodity, but in a way, if you think about it, for a given airline, whether it buys a plane from Boeing or whether it buys a plane from Airbus, is not that different. So the differentiation is not that much. And also also this airline manufacturing business is fairly capital intensive. So when these things happen, then even in a concentrated industry, the pricing power might be weak. In fragmented industries, you would expect weak pricing power, which does happen with airlines. It happens in retail, it happens in consumer packaged goods. But there are scenarios where there might be strong pricing power. So take the asset management industry. Here, an asset management company might have a very strong bond with the customer. And if you think about asset management, for a customer who is very well off and very happy with the returns he is getting at a given asset management company, if the asset management company charges a 2.5% fee, which is higher than what competitors charge, as long as the customer is happy with his asset management company, he will pay that extra amount of money. So in areas where the cost is not a large percentage of the buyer's budget, and where there is a brand and a link with the customer, there it is possible to have high pricing power, even though the industry is fragmented. Next, we look at industry capacity, market share, and so on. These are all quite testable points, and it's a very long reading, so what I'm trying to do is at least highlight the points that I want you to remember. So with regards to industry capacity, if we have tight or limited capacity, that would mean high pricing power. So companies are producing at full capacity, so it is relatively easier for them to raise prices. Consider current capacity and future capacity levels. So if you are an analyst and you say that, look, this company or this industry is operating at full capacity, so it has high pricing power, that analysis is incomplete, because you also need to think about what will happen in the future. It is conceivable that the industry is at capacity today, but next year maybe the company is operating at half of the regular capacity. And if the industry goes to half of the regular capacity, then pricing power will come down, because all the companies in the industry will then be competing heavily with each other. Note that physical capital takes relatively long time to establish, and it is quicker to shift financial and human capital to new uses. Market share stability. This is impacted by barriers to entry, switching costs, and new product introductions. So you can apply common sense here. If barriers to entry are high, switching costs are high, and new product introductions are low, what does that do to market stability? Then the market stability is high, and you can define the scenario where market stability is low. Stable market share indicates less competitive industry. So if you look at market shares over the last 10 years and you see that they are fairly stable, what do you as an analyst conclude? You conclude that this is not a very competitive industry. Price competition. If price is a major factor in customer buying decisions, then price competition will be high. All right, next point is to look at the industry life cycle. So I find year in, year out, across all levels, the CFA Institute likes Porter's 5 forces, and the CFA Institute also likes industry life cycle models. So I'm not going to read all this out to you. All I'm saying here is that if you have time, on the x-axis demand on the y-axis. These are the various stages: the embryonic stage, growth stage, shakeout, mature, decline. You need to learn the characteristics of each stage. One tricky element that I'll highlight is that you might see something in the curriculum that says new industries tend to be more competitive, and yet when you look at embryonic and growth, they say low competition. So where the curriculum says new industries tend to be more competitive, they are really referring to this stage, just after growth. So this shakeout phase, this is what they are talking about. We've talked about the 5 forces. Recognize that there are also external influences on industry growth, and these are the external influences. There'll be macroeconomic factors. So how is the overall GDP growth rate impacting a given industry? Simplistically, if the GDP growth rate is high, then most industries will be positively impacted. Sometimes technology changes, and those changes in technology have an impact on industries. Demographic factors, so you have shifts in populations, maybe people becoming older. So if in a given economy such as Germany, people are becoming older, that is good for the pharmaceutical industry. Government regulations impact industries. Social influences impact industries. What you, however, do with these is you don't consider these to be forces. These are factors, and you evaluate their impact on the 5 forces. Company analysis. You need to analyze a company's financial position, product, services, and competitive strategy. From a testability perspective, recognize that there are 2 major strategies. One is a price leadership strategy, the other is differentiation. Price leadership or cost leadership means that you try to make your operations as efficient as possible and then sell your product at a very attractive price point. This doesn't mean that you are selling a product that's not good quality. It simply means that you are selling a good product at a competitive price. Differentiation means that you might be charging a high amount, but you show why your product is different and better than the competition. When you are doing a company analysis and you write a report, here are the elements of that report. You need to talk about the company, the industry. You need to analyze the demand for the products that are manufactured or produced by this company. You need to analyze the sources of supply. You need to analyze pricing, and then you need to look at financial ratios and measures. Spreadsheet modeling of financial statements helps to analyze and forecast revenues, operating and net income, and cash flows. It is a widely used tool in company analysis that can quantify effects of changes in variables in various financial statements.